This talk's going to be called The Discipline of Financial Data Science. It's called that because I'm going to show you why it really should be its own discipline, its own class, maybe its own school within the data science department if that ever gets big enough. I don't know. But what we do on a daily basis at my business is really different from what you would learn in a data science classroom. And there aren't a lot of colleges that are really tackling this topic head on. Before we get into that, a little about me. This is my company, Conlan Scientific. We just go by financial data science experts. There aren't that many people that try to claim that title. So people tend to come to us from all over the country. We're ranked top in machine learning, artificial intelligence in the mid-Atlantic. It's a good position to be in, and there's a lot of demand for our services and time right now, which is I'm very fortunate about. A little bit about me personally. I grew up in the DC area. I got my bachelor's in statistics from the University of Virginia, and I went out and started my business directly after college, and that's really all I've done. I try to lecture, meet with people, host events. I host tons of events. I used to host one of the biggest technical meetups in the DC area. I also write books. I have a ton of books out. I'm going to recommend some of them to you at the end. In terms of what I do and what I care about, these are like the top 5 disciplines that I identify with or care about or study. I have books on all of these things. I'll probably have a lot of books on each of these things. We'll talk more about it, but that just gives you an idea. If you think about financial data science and what we do in my business as a multidisciplinary application of some topics, it's these topics. This is us, there's 6 of us, and we have really interesting backgrounds. We're all programmers. I'm a programmer, I write code almost every day. All these people write code almost every day. I'm a guy that came from statistics. We have a guy that used to be an accountant. We have a guy that used to be a day trader. My wife used to be an investment banker. Now we all came together and work in this business. It really speaks to how we are just approaching finance in a different way. We're writing code to solve financial problems because we all have like really deep experience in just finance, period. The types of roles that we'll have, to give you an idea of what titles people might have in my business, we can be data scientists, we can be data engineers, we can be machine learning engineers, we can be computer scientists. Data scientists are like the boss man is a data scientist. That's just the most general title. Data engineers will be responsible for just collecting and organizing data. It's a big enough job if your data is big enough. Machine learning engineers will be responsible for doing machine learning, developing the models, deploying the models, maintaining them, responding to clients that want to really tweak little things. And then computer scientists, I think that's one of the most fun parts about the job. The only job of a computer scientist is to take someone else's work and make it run faster. When you're processing big data, there are numerous ways that the algorithms can take weeks or days or be too slow to be feasible. So you got to get really creative and just make it fast. This is probably the last slide I'll brag about. We were really proud about this. All 6 of us just up and moved to Charlotte in January because we wanted to grow in this area. We thought Charlotte was just the fintech capital of the country, and we want to expand here. So before that, we were the top artificial intelligence company in DC, and we're really proud of that title. We claimed that title not doing anything but finance, which speaks to how difficult finance is. In terms of our clients, you could say, okay, Chris, you do all of this fancy work, you have all these people working for you, but who do you actually help? What do you do? Who are your clients? Who's paying you? Hedge funds, banks, and fintech are the big 3 categories I lump them into, and it goes deeper than that. Hedge fund is a fancy term for anyone that's making investments. You could be investing in absolutely anything, and you'd fall into my hedge fund bucket in terms of the type of client we have. Banks aren't necessarily just banks, they're also just lenders. You could be lending out car loans, not just home loans. You could be lending out business loans or personal loans, anything. We can help you make better loans if you're a lender, just like we can help you make better investments if you're an investor. And then the last bucket is just the general financial services bucket. They're all in fintech because they're approaching us to help them with technology. So everyone that's not directly investing or lending, pretty much a fintech company, and we'll work with them too. I like to brag about this too. We have a huge data warehouse. There's private data out there, there's public data out there. For the public data, we buy it from tons of different vendors. We know who to talk to for every piece of data. We know how to get the best data from every person that provides the best data. We have very deep vendor relationships. And then we warehouse all this stuff in real time all the time. So any given point in time, we have billions of data points on stocks, options, billions of financial data points, millions of alternative data points. And that's the data engineer's job, right? I contribute to the data engineering, our data engineer contributes to the data engineering, but maintaining all this is a really big deal. And one of the reasons that we're so in demand is when a client will, this is just for Apple, what you're seeing on the slide right here, just data points related to Apple stock. One of the reasons that we're so in demand and people see us as so valuable is that if you start working with us, if you become one of our clients, all this data gets immediately plugged in to your project because it's publicly available data we own. We plug it right into your project, and if it can help your project, we'll use it. But most of our clients are also coming to us with very valuable private data that is only theirs, and they're asking us to extract value from it. We can typically augment it with a lot of this publicly available financial information. Now the technical part of the talk. Before I get into this, I want to understand my audience a little better. You can be multiple things, but raise your hand if you consider yourself a data scientist. Raise your hand if you're primarily business finance. Raise your hand if you have machine learning experience. Okay, so we got a lot of business finance, not as much data science. It's almost 50-50. So I will keep that in mind because some of this can get very technical. Why is financial data different? Whether or not you are programming or you're a business administrator, it's important to understand why financial data is different. Because if you're a programmer, you're going to deal with these technical problems directly. If you're a business administrator, you have to weed through all the hoopla out there about why data and AI is so helpful and understand why the promises that people might make about financial data come with very different fine print than the promises people make about other data. The reason that this chart up here is on this slide is because it really makes a point about why financial data is different. This is a portfolio of video game stocks. If you bought all the publicly available video game related companies on the US market and held them for the past 10 years, your portfolio would look something like this. How on earth does someone get around to predicting something like this? It looks like a random line with a lump in the middle. Here's the big 6 points. This is kind of an outline about what we're going to talk about. We're going to go through 6 sections that correspond to these. First, low signal to noise ratio. All features are derived features. I'm not going to read through this. You guys can read it. We're going to go through these big 6 sections. But if you wanted to just take this slide and paste it on your wall for whenever someone asks you why financial data is different from all the other data they've ever worked with, these are the big 6 reasons. First, low signal to noise ratio. Everyone that deals in machine learning knows about R squared. They know about accuracy. The whole goal of machine learning is to solve the problem with the highest accuracy possible. We've all been there. If you're a business administrator, you want to hire people to do machine learning projects for you, and you might manage that project by asking your data scientists and data engineers, okay, how accurate is your model? Now that we've given you more data, is your model more accurate? These are questions that you ask in the process of managing a data business. So you got to understand with financial data, there's a very low signal to noise ratio. It means that the good information is hard to find. It's in there, it's somewhere, but it's hard to find. There's a ton of noise. Just because someone trades Apple stock yesterday doesn't mean that there's any useful information in that trading data. It could have been a guy that fell asleep on his keyboard, his face at the space bar, and it caused him to buy and sell stocks all day at random. That data would be in our data. We'd be able to see it, and guess what? It's garbage, it's noise. So this is the fundamental equation for the bias variance decomposition. If you've studied statistics or machine learning, you've seen some form of this before. This is my favorite version of the bias variance decomposition because it very clearly illustrates why financial data is difficult to deal with. People usually just look at the bias variance relationship, but what they don't realize is that there's something called irreducible error that is also a component of the noise or the error or your failure to account for characteristics of the data in your model. If you fit a model, the sum of your error is the bias plus the variance plus the irreducible error. Well, with finance, the irreducible error is enormous. So you might start with a model that just has the task of guessing zeros and ones. If it guesses a 1 when there's a 1, it's correct. If it guesses a 0 when there's a 0, it's correct. When you have that model, your irreducible error might be something like 45%. So your job in terms of developing that model is to get your accuracy from a coin flip, which is 50%, all the way up to 55%, which is the maximum accuracy you can get given how much noise is in the data. You just got to appreciate that or you're going to be disappointed. It's okay to get 55% too, because we all know, like we've all thought about stocks and trading. If you can make 1 million trades with 55% success rate, you're rich. You don't have to think about anything anymore. Next point, all useful features are derived features. The big point about this is that machine learning is not a silver bullet. When you buy data or acquire some sort of data to try to predict stocks, machine learning will not be the silver bullet. You cannot throw that information into a machine learning model and get anything useful out of it. You have to understand how machine learning models work. For example, a company's revenue. I could have all the company's revenue data in the world extremely accurate. I could even have advanced knowledge of that revenue. I could know the revenue a year in advance before it even happens, and you would think that would give me an advantage in the stock market. It might not if you are unsure about, or if you're unaware about how you need to translate that data into a machine learning model. For example, if I had one company that made $1 billion a year, another company made $1 million a year, another company made $1 trillion a year. What is my model going to do if I just throw that all that information into the model? Is it going to decide that $1 billion a year is the perfect amount? Why would it do that? Well, machine learning models can do that. That's what they're designed to do. So if you give them data that's not designed for a problem that they're trying to solve, you will get garbage out. Here's my go-to example of sort of a brain teaser that shows how difficult this problem can be to deal with and how there's no right answer. You might think that, okay, Chris, you told me you can't just throw a company's revenue into a model. That makes sense. Can I throw the revenue growth into a model? Can I throw the net income growth into a model? Obviously, the companies with the highest net income growth are going to have the most appreciation in their share price. I want to buy the stocks of companies with the highest net income growth. I would turn you to this slide. I'd turn you to this problem, and I would say, here are a ton of companies that have 2 quarters of revenue data each, company A, company B, company C. They have Q1 and Q2 revenue data, net income data. It's important for this. They have 2 quarters of net income data. We have this data on. In reality, you'd have like years and years of net income data, but here's just 2 quarters. Which company had the best net income growth? A, B, C, D, E, F, or G? Why? Which company had the worst net income growth? Why? Could you develop a formula that answered that question programmatically for any company or any data that I gave to you? Could anyone tell me some of the difficulties, maybe some ideas? How would you measure this? How would you decide which company had the best net income growth? Subtract Q1 from Q2, you're right. That would give us company F, because company F had $30 million, a $30 million difference, right? Well, what if company F has 1,000 times more assets than company E? What if company F has 1,000 employees and company E has 5 employees? So Q2 over Q1? Okay, that's a good one. Well, in that case, company E had infinity net income growth, so that's pretty high. Also in that case, company C would have negative net income growth, according to your formula, so that would not be very right.
For more data points, could you do like ratios of rate of change and stuff, seeing like how it's like changing over multiple quarters to see like the expected like revenue?
So his answer, we're getting there. We're like stumbling towards the right answer. There is no exact right answer, but you are thinking along the lines that you need to think. The answer is, it's a long formula. It's not as simple as saying revenue growth quarter over quarter is this. We have Python files and Python code in our projects that attempts to answer this problem, and those files might have 300 lines of code in them. And you might say, Chris, that's ridiculous. You're trying to measure something as simple as revenue growth. Why do you have 300 lines of code to do that? Well, it's to answer all of those edge cases. It's to try to standardize things. It's to smooth things. It's to take expectations of things. You got to get a fair comparison for your machine learning model because we logically, as people that know the basics of business, we know what type of net income growth is impressive, but you have to boil that down to just raw numbers, just a soup of numbers for that machine learning algorithm. So data scientists, beware. Business administrators, beware. It takes a lot of hard work. It's not just about acquiring the data. You have to really understand the business environment and the business implications of what's in your data. Next point, no feature is useful all the time. This is probably the biggest one. This presents the biggest set of technical challenges from a machine learning perspective. This is why the problem is really, really unique and really hard to solve. We just talked about companies with high revenue growth. Companies with high revenue growth tend to outperform, but not all the time. What if the market is priced in that revenue growth? We just saw coronavirus happen and companies like Clorox and Zoom went through the roof. Well, did those stock prices go through the roof before or after they reported revenue growth? Did everyone just assume that they would have revenue growth because all of a sudden people want to use a lot of Clorox and do a lot of video conferencing? That happens. Zoom, for example, that stock might have shot through the roof and then their earnings come in. You don't know the revenue data until the earnings come in, but once that revenue data has come in, the price falls. Because maybe investors thought that people didn't use video conferencing enough. That revenue came in below expectations. Technical indicators, big spoiler alert just for life, technical indicators are useful, but they're useful in baskets and in consideration of all the other factors affecting them. They're not useful how the internet says they're useful. Relative strength indexes and Bollinger Bands are great, but they indicate something, but not the same thing all the time. So in reality, a Bollinger Band, crossover, a high Bollinger Z-score, a high relative strength index, all these things can indicate price increases or price reversals, or they can indicate momentum or reversal, depending on the context. Your machine learning model will have to figure that out. Same thing goes for macroeconomic data. There are so many stories of people trying to trade currencies or stock indexes, big macroeconomic assets, things that are affected by the state of countries and the state of national economies. Same story, expectations do not reflect reality. Unemployment going up does not necessarily mean the stock market will fall. Look at coronavirus, look at Trump trying to trade war, look at 2008. It will tell you all the same thing. Next point, all good data is expensive. Point number 4. This is my favorite example to explain to people why good data is expensive. In America, we have the SEC, the Securities Exchange Commission. They do some good things. One of the laws that they're responsible for, or one of the provisions, is making sure that all publicly traded companies publicly report their financial data and put it in a big old database somewhere. It's called EDGAR. I don't know what EDGAR stands for, but it's where all the financial data is on public companies. What is EDGAR right now? If you go to the SEC EDGAR portal, it's ugly. It's hard to navigate. It's hard to figure out what you need. Certainly, all those numbers aren't in a big old spreadsheet for you to just download and start doing data analysis with. If you buy all this information in a workable premium data set from a vendor, someone has to open all those PDFs, turn all the relevant numbers from those PDFs into something in a spreadsheet, put them in a database, has to figure out which PDFs go to which stocks. Lots of stocks have gone bankrupt, by the way, and lots of stocks switch symbols and steal each other's stock symbols all the time, so that's a pain. Someone has to figure out when those PDFs, those 10Ks and 10Qs were released, not the dates on the PDFs, but exactly the date that those PDFs became available to the public, because that's what actually matters. Put them all in a database, serve them to you through an API, a file server, whatever. It's a lot of work. Like, that is a huge data engineering job. And It's not a unique job, but it's a huge job. Lots of companies are trying to do it, and a few companies do it way better than most companies. So we buy this. We buy this data. We don't want to do it from scratch. That's not what I'm in the business of doing. So we buy this data, and the best version of that 10Q, 10K financial data that does all of these steps in the cleanest and most reproducible and research-ready way, it's expensive. Plenty of companies do it on the cheap, and the data is pretty much useless when you talk about trading real money for real people with it. And that's just the beginning. I touched on a little bit of this. There are foreign direct listings in America that they report their financial results in different currencies. We talked about bankrupt companies. That has to do with survivorship bias. We didn't talk about this. How do I get the whole database right now versus just the updates to the database every day, especially when companies will issue revised 10Ks and 10Qs all the time? It's a pain. So anyway, the data provider does this for you. Shop for data providers, figure out which ones are the best, and unfortunately, the best ones require the most effort. They get pretty expensive. And also important to note, the best ones aren't the biggest and most expensive ones all the time. Some of the biggest financial companies in the world have the worst versions of this. They're expensive because they're hard to organize. That's the 10K, 10Q example. That's what we just talked about. Other data sets are just expensive because of monopoly pricing power. It's when I reference some of the biggest financial companies in the world out there. Sometimes that data is not even good, not even high quality, but it's expensive because no one else has it and no one else is allowed to sell it. Point number 5, data is correlated across time. This also has a huge impact on how you will be doing your machine learning work. Most stocks in the market move the same direction every day. They move the same direction as the market almost every day. Check out any of these events. I reference them all the time because they're the 3 biggest events in the past 20 years that have just decoupled the stock market from common sense. But you gotta be prepared for them. The correlation across time causes data leakage. Data leakage in machine learning is generally the concept of leaking information from your test set into your training set somehow. There's many ways to accomplish data leakage. You don't want to accomplish this, but there's many ways to do it that involve using poor methods of interpolation, involve examining the whole data set to mess with just the training data set. We won't get into that. There's a bunch of special ways to do it when you're dealing with data that's correlated across time. Cross-validation is the biggest one. How do you get an accurate picture of what your accuracy would have been in 2023 or what your accuracy would have been in 2013, given that you know everything about the market from 2000 to 2022? How do you simulate that? You don't just slice up the data randomly. If I run a machine learning model on a bunch of stock data and I slice up the data randomly, my results will look really good, but they'll be really fake. Because if there's any data from 2014 in my training set, and there's any data from 2014 in my test set, the 2014 data in my test set will look really accurate because it's correlated to a ton of data in my training set. A related topic is that machine learning algorithms are not time aware. Machine learning algorithms are matrices in, matrices out, soup of numbers in, soup of numbers out. You can't tell your machine learning algorithm which stock it's trading. You can't tell your machine learning algorithm when it's making a trade. They don't know about dates. They can't do anything with that. Setting up this problem to funnel in a soup of numbers to your machine learning algorithm and get something meaningful out the other side is a really hard problem. What does a row of your training data represent? You have n observations in your training data set. It could be 10,000, it could be 10 million, but what does that row of training data represent? It could represent a lot of things, and there's a lot of ways to do it wrong. The most stable and well-studied best way to set up a training data set for machine learning is to simulate a row of data in your training data as a trade. Because what do you care about when you're trading? You don't care about if your trade did nothing. You care about if your trade made money. You care about if your trade lost money. So set up a training data set where every row of the training data set is a trade, and your machine learning model is predicting what is the outcome of this trade. Is it a winner? Is it a loser? If you just try to predict the daily changes in stock prices, you'll get nowhere. It's just too noisy. Don't even bother. Related to the time correlation issue, related to this issue of machine learning algorithms not being time aware, when you do cross-validation, you need to do what we alluded to earlier, split up the years. Don't let any years communicate with any other years. Don't let any years pollute both the test and the training data set. There's a lot of theory and a lot of methodology behind this. I'll recommend you some books at the end about how you can do this correctly. But in general, you cannot just take a random split in your test train set. You have to slice it up by time. The soup of numbers. When the soup of numbers goes in, it doesn't have any stocks, any assets, any dates attached to it. You got to make sure it's right, because you can't just look at it and tell if it's right when it's going into the model. You have to be really confident in your programming abilities if you're going to avoid data leakage. This is also my favorite part. I love scaring people about this. You're learning a bunch of things in your data science course. You're learning about data science and how to apply ML and AI in your business administration courses. We learn about all the wonderful open source tools out there that can already do things that we need to do, how this is such a well-studied problem. Most packages out there, the open source libraries out there, I would say probably 95% of the functions in any open source machine learning library are useless for financial data science because they're not time aware. Simple as that. You know, scikit-learn has a cross-validation function that will try to make that process easy for you. It has pipelines and transformers that try to make common data preparation problems easy for you as a programmer. You can't use any of them because none of them are time aware. You end up rewriting a ton of them. It's hard. I'm going to show you, that's the fear-mongering part. When I say throw out everything you learn, empty your cup, start from the beginning, you're going to throw out everything except the model fitting function of those open source libraries. You don't want to you want to use anything except the model fitting function, because that model fitting function takes in the soup of numbers, spits out the soup of numbers. Everything else is not time aware. It's going to cause you problems. Here's a practical way to think about the problem. I'm going to show you a toy problem, a toy mathematical problem, a way to reason about why financial data is different that you can prove on paper. It's going to prove all the points that we just made on paper, really quick. The XOR problem is the classic nonlinear machine learning problem. To prove that you have a nonlinear model in machine learning, it has to be able to solve this problem. 0, 0x corresponds to 0y. 1, 0x corresponds to 1y. You're looking at rows in these x's and y's on these slides. 0, 1 corresponds to 1 on the y. This XOR problem says if there's a 1 and a 0, but not both, that's a win. Classic XOR problem. Okay, let's make it more complicated. Generalized XOR problem. Just make it way more complicated. In this version that you're seeing on the slide here, if there's 2 1s and 1 0, that's a win. You can expand this to as many columns as you want, as many 1s and 0s as you want. This is important for us to start thinking about real world problems and real world applications, because obviously you don't see this in the real world. You see something closer to this. This is typical for a normal machine learning problem, like a non-financial machine learning problem, to have a generalized XOR type of problem, something where you need to learn complicated nonlinear relationships. A neural net would do pretty well to solve this problem, because it just has a pretty simple and consistent nonlinear relationship to solve. This is the financial version. What does this reflect? This financial version is similar to the previous version, but in this financial version, you don't know which columns are useful right now. For any given row of data, you don't know which columns are useful. All these blank columns in the X here represent noise. So this is the same as before, except I'm inserting random noise in random columns. You might say, that looks impossible. How does a machine learning algorithm solve this? Well, the answer is, it's extremely difficult for a neural net to solve this. It's pretty much the worst possible problem for a neural net to try to tackle. It's really hard for a generalized linear model to solve this. I think actually a generalized linear model is incapable of solving this. Imagine those empty spaces. There's zeros and ones in this data frame, in this matrix here. There's zeros and ones. Imagine those empty spaces are values between 0 and 1. So all that you know is that those noisy values are not very extreme. They're unlikely to be extreme. So even if I filled them in with values, you could still pick out the zeros and ones. But how does a machine learning model pick out those zeros and ones? How does it learn what's important? So generalized linear model, mathematically impossible to solve something like this. Neural net, it is mathematically possible that a neural net can solve this, but it would take an enormous number of parameters, like more than your computer can handle. You don't have a million years to wait for it to finish training. I lay out the math for this. I'm going to show you it later. But we can prove on paper that the number of parameters that a neural net would take to solve this is astronomical and infeasible. Which brings us to the actual solution: decision trees, random forests, tree boosting, any of these tree-based methods or forest-based methods where you have ensembles of trees, they can solve this problem. And that tends to be what we use in financial data of this nature. And if you're a neural net purist out there and you tell me, okay, maybe an ensemble of neural net could solve something like this, maybe, but still not practical. Let me give you some book recommendations real quick, tell you how to contact me, and then we got plenty of time. I'm here as much as you guys need me for questions. This is my latest book on trading. It's called Algorithmic Trading with Python. It's up to date, it works, the data's never going anywhere. Highly recommend it. This is my older book on trading. The data's out of date. I can tell you a funny story about how I think I tanked Yahoo Finance with this book. It's in R. If you're interested in exploring these topics and you want R code, it's out there for you, but it will be more difficult to get ramped up with. This is the book that I wrote for all of my data scientists that need more computer science knowledge. Everyone that works for me has to read this because everyone needs to stop writing slow code. And as data scientists, if we don't appreciate what's going on under the hood in our algorithms, we can accidentally write really, really slow code. This book will dive deeper into the problem that we just went into, the toy problem that we went into. You can see all the math, all the proof for why I would assert that neural nets are not a good idea for financial data, whereas decision trees are. You can see the math and the growth rates for the number of parameters, but lots of good business lessons here. For business folks out there, this book has no code in it, so I recommend give this book to all of our clients so they understand how to work with us, how to interact with us, how to manage us, set expectations, understand what's possible and what's worth investing in. This is not written by me. It's a very important book. It set a lot of the standards for the way we talk about financial machine learning. Some sections of this presentation are heavily drawn from it. Highly recommend it. The code's not very good, so I recommend my book for good code. This is a great one if you're interested in just stocks, just financial machine learning for stocks. I highly recommend this one. It's also written in R if you're an R programming person. And if you want to sign up for our mailing list and just get updates about books, this is a mailing list for engineers and students, people in academia. So if you sign up for this mailing list, you'll hear about books, you'll hear about events. We host events in the Charlotte area a lot. You'll hear about future talks I'm giving, jobs. So if you want to just stay in touch with me, highly recommend that. This is my contact info. Thank you all. It's been a pleasure speaking to you and sharing this with you. Open it up for discussions. We got these slides up. Let me know if you have any questions. Well, I told you that you don't want to predict day-by-day stock prices, right? You don't want to predict the return on a stock next week because there's too much noise in it. There's also no proof there's no indication that there's really correlation from past returns to future returns on any single stock. For people that aren't familiar with the models that she's mentioning, ARMA, SARIMA, GARCH, all these are methods from the field of econometrics. And they mostly depend on predicting the future values of a time series with the past values of a time series. That's a very limiting approach in a lot of ways. And they don't do well using data from way in the past. So if you want to predict the returns next week, because you're trading, you're swing trading, you're day trading, you want to predict returns next week, an ARMA or a SARMA will not let you use data effectively from last year. But the data from last year in the stock market can be really important. If you want to hear a really funny critique of econometrics, the gentleman that wrote this book reviles econometrics. He thinks it is a mental toxin for people working in financial data science. He thinks that people are indoctrinated in it. I don't disagree with him all the time, but the way he criticizes it and talks about it is pretty funny.
Funny, I actually, this author in particular, I was looking at some of his code last night because he has some really cool Python code on how to look at blockchain code and uncover. So I saw his name and I was like, oh, yeah, I know that guy.
Yeah, and this guy is incredibly smart. I've read his books for years. The one criticism I have of the books that he writes is the code is not reproducible or very legible. That's the gap I try to fill with my trading books. But the way he scorches the discipline of econometrics is hilarious.
Mine is related. So you were talking about dates, which is a different issue than stateful, right? So there are certainly stateful approaches in machine learning that are useful for time series, LSTMs, TMs, or even the statistical approaches like ARIMA, et cetera. But that's not what you're getting at when you're getting at dates. And I was thinking in terms of time, right? Those don't understand time; they only understand state, right? That is changes, right? So I thought maybe it might be worthwhile discussing the distinction between the idea that a machine learning method doesn't really understand time, but it can understand state, right? So,
Yeah, absolutely. And I criticized neural networks a lot with this problem. You'll see my book criticizes neural networks a lot. Paul brought up LSTMs. LSTMs are neural networks. They're a little bit exempt from this criticism. When I criticize neural nets, I don't want you to feed historical technical data and historical fundamental data into a neural net. That's where I think it fails per this problem. An LSTM might suffer from some of the same problems that econometrics suffers from for stock data, because an LSTM, like an ARMA model, will say what's going to happen next given 20 previous sets of observations. And to Paul's point about understanding dates versus states, an LSTM understands the state right now, and then the first, second, third, fourth, all the way up to 20th, 100th states previously. Still doesn't understand dates, but it understands the orderedness of observations and the chaining of observations behind it. There are applications for LSTMs in our work, and we do use them. And I just want to clarify what I'm advocating against with neural nets is using neural nets to attack noisy panel data like technicals and fundamentals. Imputation is a double-edged sword that hurts you in both directions, typically. It is the number one poster child source of data leakage, because your imputation relies on mins, maxes, means, standard deviations of things in your data. Well, how are you making sure that that imputation does not depend on any data in the test set? And then when you predict things in the future using your machine learning model, how are you updating the imputation parameters every time a new piece of data comes in? There's a lot of reasons to do machine learning in general. You might be doing machine learning for research purposes. You might be doing machine learning to understand your data better or to compress your data. You might be doing research to trade stocks or predict things that happen in the future. The reason that I'm typically against imputation and I will go for just dropping data as opposed to imputing data is I always have to answer the question to our clients, how are we going to repeat this process of predicting the data in real time? So there's no look forward allowed. No distributional assumptions allowed in my work. It sounds like you've approached the problem very thoughtfully, and you're probably doing it the right way. But that's my business constraint that I have to deal with, and it's why I will typically drop values or try another approach rather than imputing values.
You ever do, so the thing that I'm fascinated by, and I think you know a lot about, would be volatility surface mapping. You ever do like machine learning with vol surface? So you're talking about derivatives and stuff. So is that something that like is in like considerization of your decision trees, like when you make investment decisions, like you look at vol surfaces and mapping of that stuff?
Yes, you probably trade options, derivatives somehow. You're aware of volatility surfaces. When you look at a volatility surface, what do you look for? What type of shape do you look for? A smile? You like it when it looks like a smile?
I like the decisions that I can make when I know it's a smile.
What do you do when it's not a smile?
You look for the inefficiency. Like what you look for what's causing the prediction to be not what you'd expected. Because like in the instance of the smile is saying that the market has forward expectations and it's like all priced in or whatever. So if it's not a smile, then you understand that there's something throwing that expectation in the point of the curve somewhere, and that's what I look for.
Cool. So that is an investment philosophy, and it may be a very profitable one. The hard part is reducing that philosophy into just a set of numbers. You can look at the smile and you can say that doesn't look like other smiles that I've seen. And for non-options traders, what he's referring to is the volatility of way out of the money versus way deep in the money versus at the money options. It typically looks like a U or a smile. Some people say it looks like a smile because it's smirking, because it's asymmetrical. But there's lots of talented technical traders that can look at the market, look at something, and identify what's wrong intuitively, visually, using their brain. But how do you teach the machine learning model to think like that and to recognize those patterns? It needs raw numbers. So when I say we use volatility surfaces, I can say technically yes, but also it's impossible to just shove a volatility surface into a machine model.
Yeah, and so then the follow-up question is, does it come to be, so let's say if I was saying, okay, I want you guys to make me your volatility surface. Do you give them decision points based on like the impact, or like how does it factor in? So like, obviously you can't use machine learning to just solve the decision process because the data problem, but like in a day-to-day basis right now, is it something that you just consider, okay, our model is expecting this rate increase to affect the market that way, and then that surface, it doesn't show that about what we're predicting is true. So like that's the mismatch, right? Does that make sense? Like is that the decision tree that you do? So you know what you expect, but then your model says something, and then you have to inference from it. Is that like how you do things today?
Last few chapters of this book will give you a lot of insight on this concept. There is a huge chasm between machine learning modeling and execution in the market. Your machine learning model spits out ones and zeros. It spits out floating point numbers. It spits out something. You don't have all the money in the world to just do exactly what it tells you to all the time. There's a huge portfolio management dimension of this problem where you say, I have access to these numbers, these predictions, the guru that is my machine learning model. How do I strategically capitalize on that information to try to make the most money in my investment account? You referenced a fully automated approach. You referenced a partially automated approach. We do both, depending on who the client is and what they want. We can do a fully automated approach where there's a system trading my stocks right now, for example. I don't know what stocks I own right now. I know that I'm short a lot of things. That's all I know. There's an algorithm trading my money for me in the stock market right now. It's fully automated. I don't have to think about it. Other people might want to look at the outputs from the machine learning model and combine them with their personal views about what the market's doing because they think that might make them more money. So there's both. Marcos Lopez de Prado calls it the quantamental approach when you sort of insert your own values on top of it. Because I don't employ investment analysts, we're typically doing the fully automated approach for our clients.
I really like what you've discussed, and I think although you've discussed it all in the context of financial data analysis, it resonates, I think, in general for me. So one of the things I tell my students a lot, and you might as well, is often the hardest part is dealing with data, right? Getting the data into the format that you need so that you can get a sensible answer in any machine learning problem is already the most time-consuming part, right? Usually. And then also what you were just saying, one of the things I do, my first project in machine learning, which at least one of my students was here, was the classic, poisonous mushroom example for classification. I have them do naive Bayes, and naive Bayes does very well on this problem, even though it violates the assumptions. So you get a 98% probability that something's, or 98% on a testing set. That's great. So I say, okay, here's a mushroom. It tested as, let's say, 98% likely to be edible. You want to eat it? Right? So there's a big difference between what your model says and what your decision is, right? A 100% chance that it's poisonous is a really big chance that it's poisonous if death is the alternative, right? So anyway, that's not a question, but I think a lot of what you're talking about is true in general, right?
Yeah, that's a philosophy about the expected value of listening to your model. It's still negative. If there's a 2% chance of dying, the 98% upside is that I get 10 calories and some minerals from a mushroom. That's a good question. I don't know what I see in the data patterns because I am that far away from the process of predicting what the market will do tomorrow. I'm that disconnected from it because I try to just look at it in terms of what the data tells me and what the model says, and I don't try to impart my extra wisdom upon the model. In terms of the coronavirus crash, the amount of noise it produced, how a portfolio would deal with going through that crash, I don't think any portfolio manager really knew what would happen. It's a black swan, no one's seen it before. Every 5 years, the general technological characteristics of financial markets change so much that the next crash will look way different from the previous crash. It's as simple as that. I mean, how many people signed up for Robinhood during the pandemic? Tons of people did. My book sales went way up. People aren't signing up for Robinhood as much as they used to. But that's a technological change that's going to affect the next stock market crash, right? The next rally, the next crash, the heavy utilization and easy access to retail trading is going to affect the next crash. That's a way that the technological environment has evolved approximately every 5 years, such that you can't predict what's going to happen in the next one. Portfolio management saves you when that happens. There's a chapter in this book, great for business people going into the investment world. It's called Surviving on Beta. You've all heard of alpha and beta in terms of investment portfolios. I can't tell you how many portfolio managers sprung up out of nowhere in 2021. And you know what all those portfolio managers told me? Those brand new portfolio managers, they said, I started investing at the bottom of the coronavirus crash, and I've been outperforming the market like crazy. My investment returns are so high. I've doubled the money on my portfolio in just a stock account. And a lot of these people, due to these natural business cycles, they will start a fund, an investment fund, at the bottom of a crash or a recession, and they will be successful in getting business for their fund until the next business cycle turns over, until they're really tested by a serious crash. This is why experience matters, why track records matter in the finance world, why reputations can be built and burnt out really quickly. Every time there's a crash, there will be a massive culling of about 50% of speculative investment funds, because 50% of those speculative investment funds won't recover. There's a mathematical argument in this book about how someone could go about convincing their investors that they are crushing it if they start at the bottom of a business cycle.